as was said, I'm representing S&P Global, and I'm actually a member of the energy division. So I spent a career looking at energy and downstream markets in terms of refining, chemicals, power, shipping, agriculture, all of the things that I like to say that power the world, fuel the world, feed the world, and create the materials that enable us to build and modernize the world. And so when somebody asks me the question, where is the capital going to flow? If I just think about just the fundamentals of, let's just start with energy. And I mean, even oil and gas, the IEA came out this past year and said, we're talking upwards of 500 billion per year just to sustain the level of oil and gas, hydrocarbons production that's currently flowing into the world. If you look at current decline rates around the world, our analysts who follow refining and downstream say between 2025 and 2050, close to $1 trillion of investment will be required just with the existing framework of most of the refining and downstream chemicals capacity that, again, is providing the materials that fuel the world, power the world, and enable us to build materials, consumer goods, durable and non-durable goods. And they're saying, it's upwards of $1 trillion, again, just to meet the current needs in terms of consumer goods. And then we can get into a conversation about power, renewables, where billions of dollars are going to have to flow. And all of that before we even start to talk about data centers. So I'll pause there and say that when you talk about where's the next $1 trillion going, we've got multiple trillions that are really just enabling, the fundamental things that kind of keep the world moving and help to take care of, 8 billion people around the world. And as that population grows, we're going to continue to need these fundamentals as we look at new investments around AI, new investments around renewable energy, new investments about decarbonization, sustainability, and all of the above. So I'll pause there and let my co-panelists add some comments.
All right, Martin.
Yeah, I kind of think about it a little bit differently, and not so much about just industry, but geographies, strategic placement of capital. And what I conclude is that capital is going to go where it's always gone, right? To the places that offer the best risk-adjusted returns. The thing that's different today is that those risk-adjusted returns will be driven less purely by growth and growth potential in different regions, but by a bunch of other factors, including political stability, strategic independence, state-led industrial initiatives, geographic and political alignment. All these factors are going to be incredibly important in determining where capital goes. I think we can all agree on the industries that are going to be important. We talk about technology and AI, we talk about energy and energy transition. Those are all important factors, and clearly a lot of capital is going to go to those places in the coming years. The question is, how will geopolitical dynamics, strategic imperatives for different countries and regions, how those alignments are organized, what impact will that have on how capital flows?
Okay, can I just flip that question before I go back to Mark? Not about where capital goes, but because you spoke about political instability, where is it not going then?
Well, listen, I think clearly
or where is it going out of?
Yeah, that's probably an easier question.
Yeah.
Look, I think geopolitical uncertainty is prevalent in many places around the world. Clearly, uncertainty about the dynamics in the U.S. Has created opportunity for other places. The question is, do those places have the resources, the dynamics, and the culture to take advantage of this moment? Capital will ultimately flow back and forth to the places that offer the greatest stability and the greatest risk-adjusted returns. So if you work your way through all of those dynamics and come back to the idea that if you want to avoid some of those risks, then are opportunities most prevalent in places that have deep, domestically driven opportunities that are less vulnerable to some of those other dynamics that I described. And so that brings you back to some traditional thinking in terms of the hierarchy of opportunity, where the US, for example, has the deepest, richest middle market, domestically dependent environment in the world. And so ultimately, that's an advantage. Now, how much some of these other geographies take advantage of the near-term opportunity, we'll have to see.
Okay. Are we moving towards a more fragmented, so to say, or regionalized investment world?
Is that for me?
No, that's for me. For Mark.
Yeah, no, thank you. Trying to think, more fragmented. I guess I still think that, and I'm thinking about the last 25 years. So let me start here on what we watched happen from the last 25 years, so from the year 2000 to 2025, and the amount of capital that flowed into China, and how China really just emerged in terms of so many different industries as they sought to secure supply chains, employ people, and essentially evolve into what had become the manufacturing floor for the world. And so I guess fragmented, so we sat and watched from a commodity standpoint. So it's kind of good to get a view here of financials and commodity, in terms of physical commodities. Many investments happen in this region, in Latin America, in North America, Canada, South Asia, all targeted towards looking at this incredible consumption that really rose in the China market as they invested literally trillions and trillions of dollars over that time period. On average, $7 trillion per year, a total of $94 trillion invested as they, again, were manufacturing their own steel, manufacturing now solar panels, manufacturing turbine blades, manufacturing many consumer goods, both durable and non-durable, that were re-exported and sent around the world. So from a fragmentation standpoint, I guess you would say with today's combined geopolitical turmoil, with a more bilateral approach starting with the United States in terms of trade, evolving from what was more of a world order of multilateral discussions around trade, that I think as we sit here today in 2026 and say, where is this going? To answer your question, I'd say, yeah, it probably does start to become a bit more fragmented, because if now my priority is going to be, if I think about all those countries that were investing not only for domestic, but also for China, because the consumption was so massive, and China also building its own, now it's plateauing to a point where now maybe I'm thinking more about my own country. And therefore, it does start to become a bit more fragmented compared to what we saw the last 25 years.
Okay, we'll talk about risk and resilience, but before that, let me just talk about aligning technology with people. A lot of people and conversation today around the world is not just about technology and how technology is helping and enabling economies, but also if it's going to replace people. So in that, where do you see the money go? Into people? Into technology? Are they aligned? Or are they they're completely opposite? To Mark. And then I come back to you, Martin.
Okay.
I think, the phrase that we use at S&P is, people who know AI are going to replace people who don't know AI. In other words, dive in, learn it, understand it, know how it can work for you. And and then there'll be plenty of examples where automation and technology has already replaced people. I mean, that's been happening for years. And I think now the latest in terms of generative AI and where we can go with large language models and where the whole effort is headed in terms of its ability to replace people who are your core thinkers, if you will. I would say that AI will help us make more and more data available more frequently and at a lower and lower cost, but you still need the people to interpret the data and even take a look at what the AI is generating and saying, yeah, this makes sense based on my 25 years of experience or whatever my years of experience are. So, I mean, it's a multifaceted answer to your question. Technology is replacing people. It's making certain processes more efficient, more productive, and that's not a bad thing. It's just, then you have to work on the redeployment of those people and upskilling those people so that they can also be employed.
I also like what you just said. You said that people who are using AI are replacing people who are not using AI, and that's a very significant statement. Would you like to add, Martin? Yeah. No, you disagree?
No, I agree. To me, it's just a matter of timing. Look, technology in the short run will certainly displace human capital, but humans are innovative, creative. It will spawn new products, new services, new jobs. And so the question is, how do we bridge from the displacement to the innovation, which will ultimately come? So it's just that time to transition, which has certainly been the case every time we have a quantum leap in technology.
Okay, then how is the investment thinking now evolving? How are long-term investors looking at risk and resilience in this environment?
Look, we talked about the geopolitical risk, and you talked a little bit about realignment. I think supply chain security is important, and I think that will be a big factor on these alliances that emerge. As smaller economies will need to make sure that they're aligned with partners who can help support their need for commodities and other inputs into their economy. So that'll be a critical factor. Demographics will be a critical factor. All those things will come into play. Education, the education of the workforce, access to technology, AI, and so forth. So those will all be factors. All the things that we talk about that are traditionally factors in determining where the risk is will determine the outcome.
Okay. Mark, how is S&P Global then adapting to methodologies that allow you or enable you to look at climate risk, supply chain disruptions, so on and so forth?
Before I comment on what we're doing, I did want to just to add one note to what you had said earlier, because I think what's important here is the technology develops, that you get alignment. You were talking about alignment.
Yes.
And I think it's critically important that, because this is what it helps the investor community, that you've got the alignment of the technology with the markets, with the policy, and that the policy is informed. And when I say policy, I mean government policy. In the example I use is as we watched the whole decarbonization effort unfold because of climate risk, there were many, many goals that were set that got out way beyond what the technology would allow, and probably way beyond what consumers would accept. And so in the last year or so, we've seen a more pragmatic approach to sustainability, to decarbonization of assets in these sectors that we're following so closely. And it's just better aligning the policy with what the technology can provide today, along with what the market will accept. Because once you have those three things aligned, then you've got investors who will come in with more confidence that the consumption is going to be the demand, and therefore I can build the supply and invest in that. So anyway, that alignment from our perspective is critically important. Now, what is S&P Global doing? So S&P Global, 4 divisions around the world, 40,000 people. Our CEO, Martina Chung, took over in 2024, and she dove in headfirst on the whole AI side. So I'll go there. And we've created our own sandbox, if you will, that allows every single colleague across the company to really experiment with and dive into AI, not only trying to develop tools that we can use internally to become more efficient internally, but also how do we set up things that our clients can engage us with that helps the client be much more efficient in terms of how they consume and use our material. So working with all of the big name hyperscalers from Amazon to Google to Microsoft, Alibaba, on down the line, OpenAI, basically all of the ones that are out there who are leading the charge. We're not on the cutting edge, but we're in that front pack, if you will. I think about the 10K race, there's always a pack at the front. And so we may not be at the very, very front of it, but we're trying to stay up there so that we can try to see what's coming at us in terms of the investor community, expectations on us to become more productive, and our ability to provide useful tools to our clients so that they can become more productive as well.
Martin, in terms of investments, and when you're looking at where is the world going to invest next, how does the sector really prioritize? Because I do see that climate is a really important aspect, but really down the pecking order when it comes to investors looking at that sector. So how do you prioritize? Are the current financial tools good enough in a world that's changing ever so fast?
That's a good question, and one we spend a lot of time thinking about, and I think particularly for this audience. Obviously, the social construct globally is the golden goose, right? It's the goose that lays the golden egg, and I think to really lay the proper foundation for growth and prioritize capital, you have to invest in nurturing the golden goose. So you have to invest in education. You have to invest in a financial construct that makes capital available broadly to people so that they have opportunity. You have to invest in healthcare so that people are healthy and vibrant and able to pursue their needs. And that's sort of foundational as a government, is to making sure that those industries are stable and helping to create opportunity for society, but importantly, for all of us who participate in these capital markets, it's critical for us to invest in those things, because that is the foundation from which all other wealth and opportunity is created. So if I were thinking long-term, going forward, is the strength and stability of our social construct is paramount to create the foundation for growth. That, in fact, is economic infrastructure. And so I think prioritizing those important industries lays the groundwork for growth.
Are the current financial analysis tools enough to read what's happening? Because the disruptions, the changes, policy changes, government decisions are unpredictable today.
Look, I don't think they are, right? I think you have to have a pulse on your communities, right? And have as a priority safety, trust, not just domestically, but internationally, so that the system people can invest with confidence. I look at the situation today, so many capital allocators are holding back and waiting to see how things are going to stabilize before they make big economic commitments, especially companies in launching new products, new factories, and so forth. How do I make these decisions in the current environment when I don't know what policy might be 24 hours from now? Look, investing in the trust and stability of our community is paramount.
Okay, Mark, then the same question to you, just put in a different way. What role do data quality, transparency, and ratings now play in really directing investment?
Yeah, I think the challenge that you were articulating there is spot on. Is with so much uncertainty on policy, wherever you go in the world, how do I, as an investor, make decisions that can enable me to feel confident in terms of the dollars that I'm putting down to the things that I find as a priority for my company? I'll come back to AI, because this is where we're headed. You asked the question, are the the models good enough yet? I'd say no, but they're getting better. And we're going to, I think, eventually get to this balance of personal data versus public data, because the ability of these models to consume large quantities of data, look backwards and help us think about what we can expect looking forward through scenario modeling. I mean, the only way that in the work that we do with our clients, that we try to help them understand what could be possible in the future, is through various iterations around data that, for example, that's looking at what could happen to the price of crude oil. Could it go up above $100 a barrel? Could it drop down to $40 a barrel? What does that look like? And to be able to run models and run information quickly to provide answers and views on a given scenario is really kind of where we're trying to get to with our client base, all the way down into the financial side of it. And that's where AI and the technology comes in, is its ability to consume an unbelievable amount of data and run iterations and algorithms around what has happened and what may happen in the future is really what we're working towards. And that speed of decision-making is really what's becoming one of the key differentiators out there. Because can you provide enough information around a scenario model that allows the investor to assess the risk and therefore make decisions and keep moving forward? Heard a fascinating conversation yesterday about one of the keys for this region is making decisions, right? Don't prolong decision. Make a decision and then pivot if you need to, but make a decision. But providing good quality data and analysis around that has historically been the challenge. But now it's I will say, the ability to do that, I'm not going to say it's getting easier. It is getting more sophisticated. It may be better it'll be better able to serve the needs of the investors of the future.
Okay, we are here. Oh,
I was going to say, it's just an interesting frontier. I mean, data will be more accessible. Decisions will be more definitive, more certain. But clearly, the availability of data broadly and transparency is critical to the first point I made, which is trust, right? The more transparency we have, the more trust we have, the more stability we have in the system. And I think people can be more decisive and take more risk because they understand it better. Now, what happens when all that information is instantly available to the masses? What will be the differentiator, right? What will make one company more successful than another, one society more successful than the other? I don't know, but I imagine it's going to be somewhere around innovation, creativity, and the strength and stability of the social construct that will be ultimately what makes the difference. So this is new territory, and I'm sure, as it has happened with any advances, huge advances in technology historically, there's going to be some dislocation and some disruption and some instability. But I think at the end of the day, we come out in a better place, and there'll be some.
you've just drawn me to the last question of the conversation that has to do with data. Now, do you see a growing gap between data-rich and data-poor markets in terms of access to capital? And the question is for both of you, a minute each, or maybe 40 seconds each.
Again, you're looking.
Watching the clock for you.
Yeah, okay. You're saying data-rich versus from a regional
Data-poor
perspective?
markets, from markets perspective. Now, you define it.
Yeah. I guess, again, from my perspective, I'll just say I think the data is available. It's getting easier and easier to grab that data and process it and develop it into models and algorithms that can help the client base. And that is where part of the race is trying to be as data rich as you can and process that data as quickly as you can.
Look, I think as we see in small companies and large companies, the ones that are advantaged are the ones that have their data organized and accessible so that it can be accessed, manipulated, analyzed, and used to make decisions. And so when I think about not just a small company, but a large company and a government, I think those who are more organized, have had a history of transparency, can make their data as trusted and accessible, and will use to make decisions quicker that give them an edge in advancing. So yes.
Okay. On that note, Martin Nesbitt, Mark Eramo, thank you so much for joining me here.
Thank you.